Well, let's separate the politics from the macro policy implications. Look, obviously trade is important. It's important to the United States. It's important globally. It's also important that the U.S. engages in terms of trade that the U.S. feels is to its benefit. Now, we talk about all the issues going back and forth with China. What matters most to the U.S. is actually NAFTA. Because if you think about the bilateral trade that crosses between the Mexican border and the Canadian border and the logistics chain that is across North America, that really matters a lot. So a lot of people are concerned about why are we focusing on NAFTA so much and why aren't we focusing a bit more on China? Because I think at the end of the day, what matters more to the U.S. economy is what happens with NAFTA. So it's not surprising that they did decide that they're going to engage on that front as well. I think the issue is, and where the politics come in, is whether that was the right political staging there or whether you wanted to get your allies on board before you started tackling a trade conflict with China.
So the market's been wondering whether Congress starts to get involved if Canada is left out of a NAFTA deal. That's been the great threat over the weekend, and many are saying, well, it's just not possible for this to happen. Congress would face a backlash. Many of those state governors across the board in all the midterm elections, the Republicans would feel enormous heat if Canada were left out of a deal. Do you think that is the case? Should the market be pragmatic here and say, well, Canada will be part of any deal that's reached?
Well, let's remember, okay, there was, if you go back only as recently as about 2 months ago, there was apparently no progress with Mexico. Apparently this was not going to get done. There was absolutely no hope for a trade accord. And suddenly these insolvable issues became solvable. So the issue is we have to be really careful not to start judging simply based on some of the media headlines or some of the statements by political leaders. It's an ongoing negotiation. In terms of Congress's role here, which is, how do they play this? Remember that Congress doesn't play much of a role in trade to begin with. It's largely the purview of the administration, it's the executive branch. So we're not going to see is, even though there will be some symbolism behind Congress saying, okay, we want to make sure that we maintain committed to free and open trade, what they can actually do on this front is very, very limited.
Mike, how do you play this? Give us two paths to profit if there is a deal, if there isn't a deal.
In terms of NAFTA, well, if there is a deal, certainly what you'll see is that I think the markets in general will be lifted. I think if we see a deal on NAFTA that's market friendly, because
that's equity market friendly.
That's equity market friendly. Because I think the view here would be, if you're able to address the issues with NAFTA, first of all, that minimizes the threat that we'll see this backlash against globalization that could lead to broader trade restrictions across the board. And I think what you'll start to see is the focus will then shift on how the U.S. and China will begin to resolve their differences. So I'd see that as being overall market positive. And I also don't think it's something that markets are fully priced in yet.
But just on the other side of the coin, though, if we don't get a deal, do you continue to ride the dollar higher, take advantage of rising 10-year, 30-year yields at this point? I mean, is there another side of the coin where you buy just some safe haven protection and barbell it until you know what the answer is?
Well, one of the things that we've done in terms of our positioning is we have put some hedges in our portfolio. Not specifically around trade, but the realization, of course, that we're starting to see some of these macro issues. Certainly the U.S. economy is still on firm footing, although the global outlook's a little bit less even. And even these trade issues, even if they ultimately get resolved, they can certainly add to short-term volatility. So we have put some hedges in our portfolio, which, by the way, includes a long 10-year Treasury position.
Mike, just on trade, I said today whether the trade deficit figure that comes in today is $48 billion or $52 billion. Quite frankly, I can't tell if that's a good figure or not, whereas I can see if I see ISM manufacturing through the roof at 14 years highs. That is unambiguously good for American manufacturing. Tell me, the whole premise of what the president is doing, which is basically trying to get the country to some form of balance, possibly even a surplus, which seems a very big stretch. Is there a worth in this strategy for America overall, given the fact that it consumes an awful lot and pays for them in dollars?
Well, let me go back to your issue about the macro drivers here. So first of all, when you mentioned about the ISM manufacturing, and then obviously we get ISM non-manufacturing, what you are seeing is that the economy is on firm footing right now. The U.S. economy is really doing well, and for the first time since this expansion began, we're seeing all the main contributors are positive. The consumer sector, business investment spending. So we are seeing this more synchronized expansion. In terms of what we can expect in terms of potential risks of fallout in terms of the macro picture from trade, I actually think they're fairly limited, simply because we don't expect to see the real worst case scenario where we see a complete breakdown, where we see a complete repudiation of all trade accords. Instead, what we're likely to see is this process of some contention and then breakthroughs to continue.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.